Early stage companies, as we all know, face a huge challenge in raising funds as they don't have the proof of the pudding until then. So as per venture intelligence data, Indian startups raised 10.9 billion till December 13th compared to $19.6 billion the year before. So while early stage deals remain stagnant at around $1.6 billion, growth stage deals crossed $5 billion this year compared to $4.9 billion in 2023. So today we have an esteemed panel of investors who would take us through the trends in early age investing and what startups need to get their first funding. Let me quickly introduce our esteemed panel. We have Kanika from Vertex. We have Romit from Lightspeed. We have Kushan from BlackSoil. Then we have Murli from Inflexor. And we have Shubham from Pi Ventures. So the first question that I would like to put forward is, what do you look for in startups while making your early stage investments?
I think it's a broad question, and from our perspective, Vertex is more of a Series A and Series B fund. So typically when we meet companies or startups, they already have some sort of a product in place, and they are starting to show initial revenue or initial customer cohorts, right? So we're a little bit, we're not super early, but we're not super late either. So I think for any investor, the first thing we want to look at is market. Is the market potential large? What's the competitive scenario? For most VCs, we're all indexed on supersized returns. So for us, there needs to be enough space for a company to get to, let's say, $100 million of revenue in the next 4 to 5 years. So that's the first question we ask. Is the market large and interesting enough to build a large business? The second, of course, is the founder well suited? Do they understand the market well? Do they understand the consumers well? And third is, if the company has revenue, then we would also ask some questions about early consumers. What's really the value proposition which is hitting the market and where consumers are willing to pay money? I think this is very important because, there are ways to scale with discounts, there are ways to scale with freebies, but at some point, true product market fit is when consumers start valuing your product and pay for you. So for a little bit later stage companies, I think that's the third question we'd want to ask up front.
I think Kanika has covered most of the points. I'll just add one more point. I think Kanika spoke about founder market fit, right? Like, is this the best founder to scale a particular idea in a particular sector? So I think that's very important. At Pi, we come in probably a stage earlier than Kanika at Vertex. We do seed and pre-A, like to be the first institutional check into a firm. And we only do deep tech. So for us, another additional requirement is, do you have a technology moat? Moat can come from various sources: tech, product, distribution networks. For us as a fund, you need to have significant tech or IP moat. So that's something else that we look for, and whether that's been demonstrated at a prototype level, at a lab level, and is not just a paper plan. So I think that's one additional thing that we look for in addition to what Kanika mentioned.
Yeah, I think you ask any investor, they will come down and basically they'll say that there are 3 T's that matter: this team, TAM, timing. TAM being the addressable market, timing is why now should your startup exist today versus at some point earlier in the future. But one of the things that at Lightspeed, and we do seeds all the time, is that there's a firm belief that special founders will create markets that do not exist. Go back in time, Ola started as an airport, drop and pick up company. What was the TAM for that? What is the TAM when Flipkart started for buying stuff online? The TAM for reseller market capped out for Meesho, and now they are the third largest B2C company in terms of commerce. So the big learning is that if we have to evaluate a company at seed, and the market seems small, that could be a type 2 error for us, which basically means there's a large outcome and you did not take that bet, and that is the most expensive mistake you can make in venture. So what it then comes down to is that founder quality becomes extremely important. And what do you mean by founder quality, right? Everybody wants to partner with a good founder. Some of the heuristics that you'd look at is that they're unusually good at distribution. We uniquely believe, I think, that there is no moat in venture business. Maybe, not in deep tech, of course, but there's no moat in most venture businesses. It's all about execution. Have they surprised you with their hustle? Are they in rooms that they do not belong to? Have they opened up networks that you feel surprised by? That's one. Second is that they have unique customer insights that you feel are very counterintuitive. Oh, is that how customers behave? I never thought of that. Is that your perspective on the market? We never thought of that. These kind of founders are special. When you're in the room with them, you actually kind of feel that energy. And so a lot of it is, of course, the analytical work. A lot of it is also just the heuristics and what your gut makes you feel about the founder. Will they be able to create markets or not? And that's what really gets us excited for early stage.
Yeah, I think all of you guys have covered whatever is there under the sun to cover, but just adding to what these guys have said, Kanika said that they're market focused, so there is always this question whether you have to be founder focused or market focused. That's one thing that I've pose as a question to multiple investors. We are founder focused, right? So founder first, market second. And the things that we look at, in addition to what Romit already mentioned, were whether they have the grit to continue when the times get difficult. What are the experiences that they had in their life to make us believe that? Second thing is, are they intellectually honest, right? So if there is a hard question and they don't have an answer, how do they answer that question? Do they beat around the bush, or do they get defensive, or do they come back and find a solution to it? Because that indicates a lot about the founder personality. And what we also believe is that company generally takes the personality of the founder and the founding team, right? So how you behave and how you operate will be the company's culture, right? So that's very important for us. Yeah.
So you guys have all answered from the perspective of the equity. We at BlackSoil are doing private credit to companies from Series A to, let's say, a pre-IPO round. So my take would be a bit different from you guys. As a debt player, we usually consider the most important criteria to be a cash flow. We do really look cash flow based financing, and we have to evaluate whether the companies are generating enough cash flow. Even they can be a loss making company, but how are they managing their cash flow? That's our primary concern. It can be through their internal accruals, profit, or they can release it from their working capital. And thirdly, could be from the investment activities like from you guys, right? So if we have comfort on the cash flow of the company, the more likely would be investing in that company.
Sure. The next thing that I wanted to ask is, maybe you can itself start, because all the answers were already addressed. It happens. So, at what stage can you really spot your unicorns? At what stage? Is it the very early stage itself, or is it at the very later stage? When Excel put in their first million in Flipkart in 2009, did they know that it would be what it is?
I feel it's very hard for an investor or a founder to know at very early stage. Everyone is trying to become that, but knowing it for confirmation that we will turn into a unicorn is more on execution rather than idea. What we have seen is a combination of a frequency and retention. Let's say, I would say maybe a use case where I'm using a product or a service more frequently, right? Let's say Zomato, you can say, Zepto of the world. There is a frequent use case. Can I combine it with the retention? If there is a possibility of this two deadly combination, and plus, it's not the only criteria, but if these two parameters are met, you have a high frequency, you have a high retention percentage, the probability of that company becoming a unicorn would be a lot more than compared to other players.
No, if any investor says that I can spot a unicorn right now, at the earliest stage, then he will be the best investor. I don't think anyone can spot a unicorn at the early stages. but you find a spark, right? There is something about this opportunity or something about the founder that is drawing us to invest in that company, right? Either he's extremely pedigreed and super passionate and has unique insights about the space, right? And he's also attacking the problem which has a large market potential, right? So these are generally the metrics that we look at when we invest. So the stage when it becomes obvious is when they hit a revenue scale where they are able to raise large sums of capital, right? So Series C, Series B is when you can realistically say, yes, this can be a unicorn startup. Until then, the risk is still out there, right? Even a Series B company can fail, right? There are many examples like that in the market, right? And to add to that, I'll just add one more point. I always tell this to my team, if you come and tell me that this investment is brilliant, you have to just make it, then I will question that 110 times, right? Because there are many examples in everyone's investing career where you think that, okay, this startup is definitely going to make it. More often than not, they'll fail. A good investment is that you see the risks, you see positives, you weigh the risks and weigh the positives, and then you make a calculated decision. At least that's my sort of way of looking at investing. Yeah.
Yeah, I think, look, Murli answered that question. Obviously, no way to spot a unicorn at early stage. What you would, however, as a good VC be able to spot or would want to spot is intent of founders to build unicorns. What does that mean? Actually, if you think about it, building a unicorn is a very atypical, unnatural phenomenon. Like large outcomes have traditionally been built by taking decades and decades. Whereas you're saying that, hey, we'll build $100 million, $200 million revenue company in 5 to 6 years. That to achieve that outcome requires a certain persona, a certain mindset, a certain level of aggression, a certain level of almost shamelessness that I'll break through any doors that is in front of me. Any good VC would be really good at spotting this founder persona. If you're good at that, you perhaps maximize your chance of, having more unicorns in your portfolio.
Yeah, I think all venture maths works on the probability that maybe 10, 15, to max 20% of your companies are going to do well. So at the time of going in, we all feel this could be a potential unicorn, but the sad reality is that probably 80-90% of them will fail. And I think Romit mentioned, right? You need the founder to be ambitious enough to sort of even trial things that no one else would. And I always tell, it's better to fail spectacularly than to not have that ambition at all, right? So if you have that ambition, there's a chance you'll build a unicorn. If you're going to have small dreams, then there is no chance in hell. So that's my take on this.
Yeah, I think spotting a unicorn is a fallacy, right? Unicorns are mythical creatures, and there's a reason why this term came about. And the reason is that I think it's not the correct thing to be valuation indexed either for a founder or for an investor. At an early stage, what we want to try and spot is that does this entrepreneur or does this founder have it in themselves to make a large and extremely valuable and profitable company. Many mistakes have been made across the world in trying to chase this elusive unicorn valuation. I would say it doesn't matter. If you can build a large company, you will get the valuation for it, you will get the outcome for it, and your investors will be happy, you'll be happy. So I think we want to index on good, high-quality companies. Unicorns and decacorns and many other animals may be formed in the process. That's something we are concerned less with.
Next question I think we guys can just address, we don't have to go in a sequence, is that because we all have spoken a lot about founders, So what would you prefer? A single founder, a 2-member co-founders, or a 3 is more the merrier kind of a thing. What is it that you look at? Anyone? Whoever wants to go first.
Yeah. I wish there was a template to this, right? I think research will show that most startups that have gotten to be successful have had 2 or 3 founders. But we could take examples of multiple startups where a single founder, through the sheer will, have sort of taken the company to new orbits, right? What we look for is a well-rounded founding team. Let me just put it this way, right? So obviously you need to have the tech chops, the product chops, but also the fundraising chops, the sales ability. So a bunch of things. It could be in a once in a lifetime solo founder, and that's good enough, or it could be split across 2 or 3 founders. I think anything beyond 3 or 4 founders starts to look like a crowd, right? Because then the equity gets distributed. There's not enough skin in the game for anyone. So typically 2 to 3 founding member team, but we've done 1 as well. So I don't think there's a template to this.
I know a company which had 9 co-founders when it started. It is Happiest Minds. Ashok Sutta led.
So I'll just add to this. Yes, I agree with with whatever Shubham has told. 2 to 3 is the ideal set, but there are 4 solo founders who have done supremely well. The only thing is that, so I'm a chartered accountant, I come from audit. One of the questions that I used to be asked is, what happens if there is only one leader or one guy who controls everything, right? The answer is everything can go wrong, right? So the risk with a single co-founder is everything can go wrong, right? You're dependent only on one guy, and if he turns out to be not so good, yeah, your sort of money is at risk. Yeah.
Right. Next, we can go it in sequence from Kanika, I think. So, because this is. So, which sectors would you look to invest in 2025? Some of the key focus areas.
Sure. So we're a broad-based fund. I think we never say never. So really, every sector is open for us. I think purely from an India perspective, there are some sectors where we think we'll do more than other sectors. So I'll just call those out. I think one is consumer, both consumer tech as well as consumer brands. We've seen just huge change in consumption patterns over the last few years, and now with quick commerce opening up, distribution is a solved problem. So if you have a product which appeals to the younger consumer and you can identify a value proposition, it's a very interesting consumer consumption story that we're seeing in India. The second segment, which is becoming very interesting, is AI-based software and services. So again, a lot of chatter around AI, but one space where we are seeing that companies are already building and getting revenue is if you can build specialized software, use AI and disrupt a very traditional industry. So, this was earlier, we could call it vertical SaaS in a way. Now, I think there's a lot more disruption using AI, and we're also increasingly seeing India is a great place to build this because we have much cheaper cost of labor. So whatever is the last 10% human in the loop problem can be solved pretty nicely here. And these are products which can be built immediately for global markets. You can just immediately start selling in the US and Europe, and that's looking very interesting for us. I think the third sector is we are seeing some maturity is around the clean energy or the clean tech space. So this involves solar as well as EVs as well as other ecosystem plays around it. So that's one sector which we think will start maturing. I think a lot of the seed funds have made investments here. They'll start coming into us. And then we're seeing very early trends in manufacturing and semiconductor space as well. So that's, I think, one place where India is very, very well poised and something we're looking to double down on in the coming year.
Yeah. Now, my answer will be a little different. So we are a sector-agnostic deep tech fund. Our last few investments have spanned across quantum, bio, robotics, space, aviation, batteries, right? So we're looking for founders who are looking to fundamentally change the paradigm and not just interested in solving small level problems. We've also made investment in semiconductor and what has changed for us, and I think for some of the larger funds as well over the last, I would say, 12 months, is that India is moving down the stack in terms of the complexity of the problem statements that founders are willing to solve. Right? We started with the broadly consumer-focused investment funds. At some point, it transitioned into enterprise software and SaaS. Now, with the government push towards making India self-reliant and net exporter of a bunch of technologies across defense, semiconductors, space, quantum, there's a lot of capital that's flowing in. There's a lot of industry, academia partnerships that have started to come in, which is leading to a like a downflow of investors, founders building the space. So fairly sector agnostic. As long as it has an IP, we are in it.
I was just joking that Kanika has perhaps answered this for the whole panel, so like everything that she said, but maybe I'll just talk about 3 areas that excite us at Lightspeed. We're spending time on right as we speak. One is new age commerce experiences. A lot of your horizontal QCom is disrupting your more traditional e-commerce marketplaces. So what could be vertical categories that get built in fast delivery? Fast is a feature. Which other segments lend themselves uniquely to fast as a feature as a delivery, right? So food is one, fashion is another, BPC is another, medicine perhaps. But either way, like we're spending time there, that's uniquely interesting to us. Second is that if you just look at the export market, like what Indians started exporting in software, we started with enterprise SaaS, then we went to B2B commerce. There is some movement of B2C commerce. Amazon global platform, India platform is growing very rapidly to the US as well. We believe it's the era for consumer tech companies built from India to go global as well. In fact, one of our portfolio companies, Pocket FM, which we seeded back in 2018, today is doing $200 million plus in revenue from US alone. We think more will be built. If TikTok can be built from China, then why not global consumer tech products out of India? Third is, of course, AI, but even in AI, there's a nuance. Of course, we're spending time on AI, agentic workflows for enterprises and all of that, but I think a unique opportunity that AI presents itself is that a lot of human-related workflows that serve, traditional industries like finance, medicine, BPOs will get automated, and you'll have a layer of AI plus human element services. These were traditionally called services companies. Why they're interesting today is that AI uniquely enables human throughput in a way that the gross margins suddenly start tending towards what a software company's gross margins look like. So these are the 3 areas that we've been spending time on and also been making investments in the last few months.
Yeah, I mean, I think you guys again covered all the sectors. There's one, for us, I think I'll talk about the last few sort of sectors that we invested in. We are also a sector agnostic firm. So we have done one healthcare device company in the liver management space. And we are also looking at one more in the cancer biopsy space. These are medical devices that we are looking at. Obviously, applied AI, verticalized AI is another sector that we continue to look at. Another sector that is very, very interesting is where we see a lot of companies, but we need to find scale in them, is, I think, power. Solving for power is going to be the next big theme, I think, for the next 10 years, because we as a country are going to get more power hungry. There are a lot of data centers which are going to come up in the next 10 years. So power will become a constraint, right? So solving for transmission losses, better efficiencies, I think, is going to be one area that is going to be interesting, right? So that's our sectors that we are looking at, apart from everything else that has been mentioned. Yeah.
I'll again have a different answer to all of them. So we are a debt player. We usually focus on the use cases of debt. rather than just the sectors. We are sector agnostic, but what we do is what's the requirement of the debt. Can be various purpose, right? Debt can be used by a fintech company for an onward lending. So that can be a use case for us. Second thing would be for financing of working capital. Predominantly we say that debt should be used for managing your working capital rather than your equity. So those companies which require working capital like B2B or D2C branch, that can be a use case for us. That's the two thing. And third thing that recently that we have also managed this thing is acquisition financing. Most of the companies are looking for debt to acquire a few companies. So where there is a use case and it's backed by a proper cash flow, that's the sectors that we look at.
Sure. Maybe you can keep the mic with you. We can start from you this time. So profitability versus scale has been a debate, right? So what according to you should early stage startups focus on? Profitability or scale? And if you can just share your thoughts.
The reason if a startup is not profitable, that needs to be known more. Is it because of the unit economics or is it because of the not achieving the scale? Let's say a startup is CM3 positive. The only thing is requiring to become a PBT positive is scale. Maybe then that makes sense for a startup to not be profitable currently. So I would really go and look down into the unit economics of the company. A company which is very thin margins with a gross margin of let's say 3-4% might not be able to turn profitable. So I would rather focus on the unit economics of the company, and if the unit economics permits, they can depend on the scale that they want to achieve.
Yeah, I agree with what you said. I think even at an early stage, you need to make money at the unit economics level, right? So the product itself or the service itself has to make money, right? The only money that ideally you should be raising and spending from VCs is to expand the market, the customer acquisition costs, right? I mean, we have seen time and again that if you are selling your product or service at a gross margin level loss, the story never ends well, right? So that is our strong belief. Even while you are in an early stage, I think you have to be profitable at the unit level. You can spend money for acquiring customers, but not at the product level, yeah.
I think it's a hard question to answer because it's very context dependent. If you're creating a market, if you focus on profitability, then you will not end up creating the market, and then as a result, you'll forsake large outcomes. Just to give you an example, we saw Zepto at Series A, and burn was a concern for us. And in hindsight, obviously, we made the wrong call to not invest. We came in on the growth round, but what we saw there was, or rather what our learning from that is, what we did not focus on is that we did not factor in that even though they were losing money at the unit level, the repeat cohorts were so strong that if that played out, they would have started making money. We didn't project that customer love forward, and we made the call that, okay, it's not profitable and hence we should not invest. Perhaps the greatest miss that we have had as a fund in the last 3 years. So should LTV CAC make sense? Absolutely. If it does not make sense, is that not good? Well, I mean, the answer is nuanced, so you really have to dig in.
Yeah. I think it's not necessary at an early stage for unit economics profitability. I think to Romit's point, I think there should be, as an investor, you should be able to underwrite a path to profitability rather than profitability at a point in time when you're looking at that investment. So if you feel that there is a path towards profitability for whatever reason, maybe once they have the network effect, they can jack up their prices, or once they have enough cohort usage, they can introduce subscription, whatever it is, then it makes sense. If there is no path towards profitability, then obviously it's a losing value prop for everyone that's part of that venture.
Yeah, I think it's whatever these guys said. I think no investor should be asking an early stage company to be profitable, right? At early stage, it's always scale. I think what everyone is saying is basically the scale should be meaningful, which means that if you're spending X amount of money to acquire a customer, that customer should be retaining / engaging / buying again, depending on whether you're a B2B or a B2C company. So, if you are not scaling aggressively in the beginning, then you are actually, selling yourself short, especially if you think that your product fits the market. But there are metrics on revenue to first convince yourself and then your investor that the scale is meaningful. This customer can add value in the future, and that's where all the retention or engagement or LTV calculations come. So I think that question is becoming more pertinent, and for anyone who's fundraising, that's definitely a question you'll be asked. And I think the second proxy, which a lot of investors will now look at, is gross margins. So, on a net EBITDA basis, EBITDA loss and, many percentages of EBITDA loss is okay, as long as, you're making some money at the top. So whether you're a take rate business or whether you're a gross margin business, as long as you're able to showcase that, yes, whatever money you get from the customer, you're able to keep some of it, and that some of it will go towards eventually at some point making the business profitable, that's totally acceptable. But the early stage answer is always scale. And if you're doing the things right, then the profitability question will be answered at some point, down the line.
Sure, thank you so much. While I would like to listen more, I'm told I'm completely out of time. So thank you so much for your brilliant insights. A big round of applause, please. Thank you so much.